Imagine two titans battling it out in the corporate world. On one side, you've got the relentless pursuit of profit, and on the other, the urgent call for environmental protection. Can they ever truly align, or is it, always a zero-sum game? You might instinctively see environmental regulations as just a burden on businesses, right? A cost they simply have to bear. But what if going green wasn't just about compliance? What if it was a strategic move, something that actually boosts a company's competitive edge or even their bottom line? This isn't just hypothetical, it's a really big debate that's been shaping policy and corporate strategy for decades now.
That's exactly it. We're diving right into the heart of that tension, between protecting the environment and economic performance. And for this deep dive, we've pulled together a pretty fascinating collection of research. Everything from really detailed empirical studies on how financial markets react to, well, real-world case studies looking at national green growth initiatives.
Right. And our mission today is to cut through all that noise, to kind of distill the most vital knowledge from these sources. So you, our listener, can walk away really well informed on this critical topic without getting sort of drowned in data. We're going to uncover some genuinely surprising facts, like how financial markets actually value carbon emissions, the nuanced effects of different kinds of regulations, and even how consumer-facing businesses might approach climate action differently than, say, business-to-business operations. Get ready for some definite aha moments, I think. Okay, so let's unpack this core idea first. On one side, you have what's often called the cost effect. This is the traditional view, isn't it? That environmental regulations inevitably add production costs, which can then, crowd out capital that could be used for other investments, maybe weaken international competitiveness, and ultimately have a negative impact on economic growth. I think there was one study back in 1999. It found that an emissions tax could boost productivity by forcing older kit to be retired, but it would also hit profits.
That's certainly been the conventional wisdom for a long time. Yeah. But then you have Michael Porter's idea, the Porter hypothesis, proposed back in 91. He argued that appropriate environmental regulation, and that word appropriate is key, can actually spark innovation, what he called innovation offsets. So new processes, new products, maybe cost-saving efficiencies, things that can actually make the company more competitive, even with those added environmental costs. What's really fascinating here is how these two powerful views just constantly push against each other in the real world and in the research.
And the Porter hypothesis itself, it isn't just one single idea, is it? It sounds like it has different layers.
Precisely. Yeah, researchers often talk about a weak version and a strong version. The weak version mainly asks, does regulation stimulate innovation? And that's usually measured by things like R&D spending or the number of patents filed. But Porter himself and van der Linde stress that innovation is much broader than just patents. It covers product design, the markets you serve, production methods, even marketing. The strong version then looks at the bottom line, the ultimate impact of these regulations on overall business performance, so company productivity or even a whole country's competitiveness. And whether the hypothesis holds true often seems to depend on specific circumstances, like the industry's market structure, or maybe if firms are already operating way below peak efficiency.
Okay, so the theory suggests regulation should spark innovation. That's the core idea. But does this innovation magic really happen in practice? Do stricter environmental rules actually light a fire under companies to innovate? Because this is where it gets really interesting, right? The actual evidence seems quite mixed.
It is indeed very mixed. For example, a study by Jaffin and Palmer back in 1997, they looked at industry-level data and found basically no statistically significant link between what companies spent on compliance and their patenting activity. Now, they did find a small positive link with R&D spending, but it wasn't a huge effect.
That seems to lean against the weak Porter hypothesis, doesn't it? At least the patent part. What about more recent examples? Anything jump out?
Well, let's look at China's experience. They rolled out these carbon emission trading schemes, ETS, as pilot programs in 7 regions starting around 2014. A more recent study, 2021, I think, by Chen and colleagues, they found this ETS pilot policy actually decreased the proportion of green patents in companies by 9.3%. They also saw what they call a time lag suppression effect on green innovation, meaning the negative impact wasn't immediate. It sort of built up over time, lasting up to 4 years, like a delayed reaction.
Wow, a decrease in green patents. That's the exact opposite of what Porter predicted. That's a pretty big finding.
It truly is, yeah. And this negative effect was particularly strong for what they call green invention patents, the really groundbreaking, potentially paradigm-shifting innovations. Less so for the green utility model patents, which are often more incremental improvements. And this stifling of green innovation was especially noticeable in smaller companies, manufacturing firms, non-state-owned enterprises, particularly in China's eastern and central regions. So the researchers basically concluded that the weak Porter hypothesis just hasn't panned out in China's carbon trading market so far. They reckon that companies facing reduced cash flow and maybe a lower expected income, they chose to just cut output in the short term instead of making those big long-term investments in green tech R&D.
Okay, so innovation is one really crucial piece, but maybe a complicated one. What about the more immediate signals from the financial world? How do markets, those ultimate arbiters of value, how do they react to a company's environmental footprint, specifically its emissions? Does being green actually pay off in market value?
Well, earlier studies, looking at firms in places like Australia, the S&P 500, the EU's ETS, they've pretty much unanimously concluded that greenhouse gas emissions are negatively associated with a firm's market value. Even companies that voluntarily report their emissions tend to see this negative link. And those that don't disclose anything at all, they often face an even bigger penalty from the market.
Okay, so emit more carbon, generally lower market value. That seems pretty clear cut. But does regulation change that dynamic? Or does it just kind of formalize the penalty that's already there?
That's a critical point to dig into. Let's take the UK as an example. The Companies Act there in 2013 made GHG emissions reporting mandatory for firms listed on the London Stock Exchange. Now, a study looking specifically at this regulatory change found something interesting. While that negative link between market value and carbon emissions was still there after the rule came in, its magnitude was significantly smaller, about 40% lower, actually. This suggests that maybe mandatory reporting, perhaps because it signals accountability or forces companies to actually track this stuff, might mitigate that negative market reaction somewhat.
40% lower. Why would that be? Just the act of reporting?
Well, one explanation is that these new disclosure rules might push firms to actually implement new initiatives to cut emissions. And seeing that, investors might then re-estimate future risks or costs downwards. There was another study looking at environmental liabilities, and it found their negative valuation was much lower after new reporting regulations came in. So transparency seems to help, even if it reveals a problem. Information beats uncertainty, perhaps.
Okay, that makes sense. What about the difference between a company choosing to disclose versus being forced to? Does the market see those differently?
That seems to be a really crucial distinction, yeah. Some recent research suggests that while voluntary GHG disclosure, sometimes the market actually views that negatively, potentially seeing it as just, a PR move, an attempt to look good, legitimacy-driven stuff. But mandatory disclosure, interestingly, seems to be positively associated with firm value. So it suggests that these mandates can effectively decouple the act of disclosing from just pure image management. Investors seem to reward that required transparency. They see it as more credible, perhaps.
That's a really powerful argument for mandatory reporting then. Okay, what about direct investments? When companies actually spend money specifically to reduce their carbon output, their abatement efforts, do those pay off financially in market value?
Right, looking at corporate investment in carbon abatement, or CAI. The picture here is, well, it's complex. A multi-country study found that overall for the full sample, the valuation effect of this kind of investment was generally negative. However, for U.S. firms, it got more nuanced. The effect was non-significant in the really carbon-intensive sectors, but was actually negative and significant in the non-carbon-intensive sectors, which is a bit counterintuitive maybe. But one interpretation is that, in the U.S. context at least, investors in those heavy-emitting industries might recognize the longer-term benefits of CAI, that it could eventually outweigh the high upfront costs, so they don't penalize it as much. Similarly, another study, this one in the pulp and paper industry, found economic benefits from environmental capital spending only for the firms that were already low polluting, not the high polluting ones.
Wow. Okay, so it's definitely not one size fits all. It really sounds like the context matters hugely. The type of firm, their industry, maybe even who their customers are. It can all shift the impact. Let's dig into that a bit. What does this mean for different kinds of businesses?
Absolutely. The context is key. There was a recent study looking at South Korean firms, and they specifically differentiated between business-to-business, B2B companies, and business-to-consumer, B2C ones. They measured financial performance using something called Tobin's Q, which is widely seen as a good indicator of a firm's intangible value, things like reputation, investor trust, risk perception. Basically, it compares the market value of a company to the replacement cost of its assets.
Yeah.
It's a good proxy for that sort of extra value the market sees.
Right, Tobin's Q. Got it. And what did they find when they compared B2B and B2C using that measure?
Well, this is really interesting. For the B2B companies, they actually observed a positive association between greenhouse gas emissions and Tobin's Q, suggesting that for these firms, higher emissions were somehow linked to higher intangible value.
A positive link? That is counterintuitive given everything else we've discussed. How do they explain that for B2B?
The researchers suggested this difference might come down to customer pressure, or lack thereof, maybe. They argued that B2C customers, ordinary consumers, tend to exert much more direct pressure on firms about climate change issues than B2B customers do. Think about it. If you're buying coffee, you might care about the brand's sustainability. But if you're a business buying, say, industrial ball bearings, maybe cost and reliability are just way higher priorities than the supplier's emissions profile. So the implication is that maybe you need stronger regulatory pressure on the B2B sector because that direct consumer pressure just isn't there in the same way.
Okay, so public perception, consumer pressure, that really is a driving force, especially for those B2C companies. How else do these less tangible things like reputation influence the sort of green bottom line?
Oh, significantly. Firm reputation, even things like social media sentiment play a big role. Research shows they can positively influence that link between corporate environmental performance and financial performance.
Yeah.
Makes sense, right? However, there's a catch. If a firm already has a weak reputation, just having a strong social media presence might not be enough to translate its positive environmental actions into better financial results. It really highlights the importance of, let's say, strategic engagement in social responsibility. Going beyond just sponsoring a few environmental things and really embedding it. That seems to contribute more to firm value, especially for those consumer-facing firms again.
That makes a lot of sense. You need the substance behind the image. What about something you mentioned earlier, organizational capital? That sounds a bit abstract. Can you unpack that?
Sure. Organizational capital basically refers to all the internal stuff that makes a company tick. Its unique business practices, its processes, systems, designs, even its corporate culture. It's considered a really valuable resource, and it's hard for competitors to copy. And studies are showing that firms with high organizational capital seem to be exposed to less climate change risk. And interestingly, this seems particularly true for regulatory climate change exposure. The risks that come from changing rules and policies which are influenced by human decisions and innovation, maybe less so for the physical risks like from natural disasters. So it suggests that having robust internal practices, a strong, adaptable culture that can really help a company navigate and mitigate the impacts of evolving environmental rules, it builds resilience from the inside out.
Right, resilience. Okay, let's try and ground some of this in a specific national context.
Oh.
South Korea has been mentioned a few times. They've been quite a strong proponent of green growth, haven't they? Introduced some significant climate policies. What has their real-world experience actually revealed about the impact of these policies on the ground?
Yeah, Korea's a really interesting case. They've been actively pursuing carbon neutrality. They've got ambitious targets like a 35% cut in GHG emissions by 2030 compared to 2018 levels. And they put policies in place quite early. There was a Low Carbon Green Growth Framework Act back in 2010, then a Target Management System, or TMS, in 2011, and an emissions trading system, the ETS, in 2015. So definitely signaling a shift towards using more market-friendly incentives.
Okay, so a strong policy push over more than a decade. What were the actual results? Did it work as intended?
Well, Korea's overall GHG emissions intensity, that's emissions per unit of GDP, has been generally declining since the 2000s, which is positive. But the outcome for businesses themselves seems a bit more mixed. For instance, one study looking at Korea's ETS found that both the initial phase, where allowances were mostly free, and the later phase, where there was a small percentage, 3% of paid allocation, both resulted in a negative effect on carbon emissions relative to sales, which suggests that just implementing the trading system, even with those free allowances, sent a strong enough signal to help slow down the rate of emission increases.
Okay, so the signal helped even if allowances were free. That's a positive step. But you mentioned mixed results earlier. What was the downside?
Right. Despite being, internationally praised for this bold attempt at green growth, at least one analysis really questions the overall success of the Korean Green Growth Initiative, arguing it was kind of quickly co-opted by the paradigm it was supposed to supplant. That's a direct quote. Basically, it offered decarbonization, but maybe without requiring really serious changes in societal values around consumption. Growth was still the main driver. So while the policies were there and emissions intensity fell, it maybe didn't fundamentally change the underlying economic model as much as hoped.
That's a critical point, the difference between policy signals and deep societal shifts. What about the more direct financial impacts on Korean firms? Did the policies create clear incentives?
Yes, and this is where it gets quite tangible, especially for you as a learner listening in. A recent study focusing on Korean manufacturing firms found a clear positive correlation between higher greenhouse gas emissions and a higher cost of debt. So emitting more meant borrowing money was more expensive for these companies. That's a very direct, tangible financial incentive to cut emissions, hitting them right on their financing cost. And related to that, foreign investors actually showed a preference for companies that were involved in that target management system, the TMS, further linking environmental engagement directly to investor confidence and potentially better financing conditions.
Okay, so clear financial benefits, or at least penalties, are emerging. Higher borrowing costs for higher emitters. Given this complex mixed policies, mixed results, but now these clear financial signals, how are specific industries within Korea actually responding? Are they innovating?
They are definitely responding. Key industries like steel, for example, are exploring things like hydrogen reduction technology. Big shift. They're also increasing the use of steel scrap, moving towards more circularity. The semiconductor and display industry's huge electricity users, high indirect emissions, plus process gas emissions. They're really focusing hard on energy efficiency. And this whole concept of the circular economy is gaining a lot of traction, generally, trying to recycle materials right back into production, minimizing waste and resource use. You even see innovative uses like replacing coal with waste plastics in vinyl and cement production. However, there's a recognition that achieving full carbon neutrality in manufacturing often means increased production costs. And that likely requires a broader social consensus, getting consumers potentially ready to pay more for low-carbon products. That's a big hurdle.
Absolutely. So, looking back across everything we've discussed, from that core theoretical debate, the Porter hypothesis, to the real world impacts we're seeing in places like the UK, China, Korea, it's crystal clear that the relationship between environmental action and business success is anything but simple. It's really complex. We've seen how mandatory transparency can genuinely shift market valuations, maybe for the better, how consumer pressure creates very different dynamics for B2C versus B2B firms, and how even those intangible things like organizational capital, that internal resilience, can play a real role in reducing a company's climate risk exposure.
Exactly. And we've also seen how the specifics of policy design really matter, like China's ETS experience, where it seemed to have these unintended negative consequences on green innovation, at least initially. Even while other places, like Korea, are finding ways to directly link emission reductions to lower borrowing costs for companies. What really comes through from this deep dive is that going green isn't just one thing. It's not a single path. It's this complex interplay, isn't it? Where public perception, regulatory design, market reactions, and even a company's own internal capabilities all interact. And that interaction dictates whether environmental action ends up being just a burden or maybe, just maybe, a transformative lever for competitive advantage.
It really hammers home just how nuanced this whole area is. It's definitely not a simple cause and effect equation.
Not at all. It's less about finding the single answer and more about understanding all these different layers of influence that are constantly at play. And, this raises a really important final thought, maybe for you listening. If environmental regulations don't always automatically spur the right kind of innovation or guarantee an immediate financial win, and yet we see markets increasingly penalizing high emissions and rewarding transparency, then what is the most effective way for you, whether you're acting as a consumer, an investor, or even an employee inside a company, to actually influence corporate environmental action in a meaningful way? Something to really think about.